Hello, everyone, and welcome. My name is Dorian Hunt. I'm a partner and head of renewable energy and energy transition tax here at Berwick. And I'm joined by my two esteemed colleagues, Marty Schmidt and Rick Ellsworth. Marty and Rick, would you take a moment to introduce yourselves?
Thanks, Dorian. This is Marty Schmidt, partner of valuation at Berwick. Been doing energy valuations for a long time and with a heavy focus on renewables and energy transition.
Hi, I'm Rick Ellsworth. I'm a senior advisor with Berwick, and I've been performing valuations of renewable energy projects for the last 30 plus years.
Great. Thank you both for being here. In this particular episode, we're focused on the topic of step-ups as they relate to investment tax credit properties. So there's a little bit of background. Investment tax credits are generally non-refundable general business credits that are generated at the moment that an eligible asset is placed into service. The amount of the credit is based on the cost basis of the asset at the time that it's placed in service. Now, it's often the case that the cost to build an asset, let's say a solar installation, is less than its fair market value at the time that it's placed in service. So sometimes there's an effort to conduct a transaction whereby the cost basis of the asset is established at that higher fair market value so that the project might enjoy a higher investment tax credit. So to set the stage, we're talking about the valuation considerations that might go into the determination of establishing that cost basis as that higher fair market value. Now, having said that, Marty, could you talk a little bit about the valuation principles that underpin the mechanisms that are required to be conducted in establishing that fair market value basis into cost?
Sure, happy to do so. So projects of this type are bought and sold based on the cash flow they're going to generate. Like any business asset, that is the primary driver. And the cash flow drivers for a renewable energy project, energy transition project, will be the operating income, the investment tax credits, and the tax depreciation benefit as well. Those are all the cash flows that are recognized. So in the transaction that you described, the developer created a solar, for instance, project, and he only entered into that project with the anticipation that it would be worth more than what he's spending on it to construct it.
I imagine that that's similar to any business venture. You enter into it with the expectation that it's going to be worth more when it's in operation than you put into it while you were building it.
When you state it that way, it's obvious. That's why you're in business and not a not-for-profit enterprise. Build something so it will be worth more. Now, as you said, the developer could keep it, could place it into service and operate it and get an investment tax credit, for instance, based on the cost that he spent. And that's a perfectly reasonable business model. Another business model is just before it's placed in service, enter into the transaction so that the new owner, the taxpayer who paid for the facility, has a tax basis of what he paid for it. Very reasonable transaction. And again, that will recognize the operating cash flows, the investment tax credit, tax depreciation in the value. So the value of the energy property is the cash flow that it will generate. There could be some small adjustments that we can get into, but primarily, and it's the cash flow that it will generate in the hands of the taxpayer. In this case, the entity that just bought the facility. So the discounted cash flow, future cash flows, is the primary driver of the value. We'll check that based on the cost and how much the value is over and above the cost, but the primary driver is the discounted cash flow. So in that last sentence, I alluded to value in excess of cost, which gets us back to our topic of step up. The industry shorthand for the difference between the cost to construct and the value, the fair market value of the facility, is the step up.
Your preference is to refer to that as the value in excess of cost, but colloquially, we hear that referred to as the step up. So is it fair for us to just assume those are synonymous terms for the purposes of this discussion?
Very good. And I do want to make the point, and we'll be making it again, that step up is not developer's profit. That's a very different concept, but step up is very clearly and succinctly what you just said, fair market value in excess of cost. How that gets allocated, how we look at that step up is a more nuanced conversation, but the step up is the fair market value minus the cost.
Now, if we could touch on that distinction you made about developer's profit just real quickly, I think the premise behind the distinction you draw is that the value of the step up is shared among stakeholders typically.
It was created among a number of parties and shared among those parties as well. So yes, it was created in the context of the construction as well as the context of the transaction. A number of different parties had to come together. The entrepreneur had to bring all these parties together to create this value. And so that's what the value is. And because they all participated, they all get a piece of the value. Just they're all in business, and that's why they do it. But again, in essence, it is the cash flows. Cash flows to each of these parties represents their share of the value in the energy property.
So Marty, you talk about the discounted cash flow analysis, the various pieces that go into it, the cash flows, the value of the depreciation, the value of the tax credits. Rick, could I maybe ask you to just give us a brief explanation of the other elements that go into evaluation? Sometimes it's not just the income approach that's going to determine the conclusion, but rather some other methods and metrics and mechanisms that might go into that determination.
The valuation process focuses on the consideration of the three approaches to estimating value. That's the cost approach, the market approach, and the income approach. Marty spoke a minute ago about the cost to construct the project, and that's certainly a consideration in valuing an energy property. But in addition to that, it's helpful to make a comparison of those costs with other, I'll say, industry benchmarks. There are entities such as the National Renewable Energy Lab and the Energy Information Administration that publish information periodically on cost estimates to construct a project such as a solar project.
And that would constitute maybe the market approach. So the transfer, we're trying to get data points that are similar as you can get to the thing.
Exactly.
We got just a quick question on that cost approach that you mentioned. Now, when we talk about the cost approach to valuation, that's the number you get conducting that process. That's different than your actual cost to build in most cases, right? When we say cost, it's the same word, but a different number typically than what a developer might actually incur to build the thing.
Yes, I mean, the developer's going to incur costs to construct, but from a valuation perspective, you also need to consider things such as financing costs during the construction period, which is referred to typically as capitalized interest. And then in addition to that, there's going to be a addition of compensation for the developer in coordinating the development of the project and bringing it to its successful completion. And those two items typically are not presented in the cost information that is published by National Renewable Energy Lab and the Energy Information Administration. So that's something to keep in mind, that those sources publish what's referred to in the industry as an overnight construction cost. So that's just the cost to construct the project. It doesn't consider any elements of financing or also any compensation as it relates to the developer profit or entrepreneurial incentive associated with completing the project.
Thank you for making that distinction. And the reason I bring that up is when we talk about step ups or the value in excess of cost, we're not necessarily talking about the cost approach determination to the valuation. We're talking about the actual cost to build the asset. So if we're trying to get our hands around exactly the quantity of a step up or value in excess of cost, that base item cost is the actual cost that was incurred by the developer to build it. So I wanted to use that distinction that you provided, Rick, thank you, to begin the conversation about how we think about whether the magnitude of the distance between the developer's cost to build and the eventual established fair market value in the valuation matters in whether we're making a determination on whether step up is justified. So Marty, can you maybe give a few minutes to talk about the different ways to measure the magnitude of that fair market value over cost or the step up amount? Do we look at it as a percentage? Do we look at it as a dollar amount? Do we look at the fair market value over the nameplate capacity and come up with some metric like that? Is it all of the above? Help us think through that.
Sure. So what's most important is that we recognize, again, that we're looking at the cash flow of the specific project that we're valuing. The cash flow is paramount. That's what defines the value. The other metrics that you're talking about are benchmarks, sanity checks, if you will. But the primary driver is, what is the cash flow value of this facility versus what it costs to build? And that's the increment. Dollars per megawatt, perhaps that can tell us something. The percentage markup, the percentage step up over cost. Again, take the value, the fair market value divided by the cost, make that a percentage increase, the step up, the markup. That has to be treated with great care as to whether this tells us anything or not. First of all, the base number, the cost, can be measured a number of different ways, because these transactions are sometimes complex, multiple transactions at different points in development. So exactly what we mean by cost and exactly what we mean by value varies project to project. We look at it, there's some valued from a benchmarking point of view, but it can't be the primary driver. We can't draw a line in the sand and say that for all projects and all time, the maximum step up is X percent over cost. That's a shortcut that is really not useful in judging the quote unquote reasonableness of the step up.
I have seen maybe an exodus to trying to find comfort in a particular percentage of step up by saying that if we're below a certain number, then that number won't cause us any problems from a credit disallowance or a credit recapture perspective. But every deal needs to stand on its own, Marty, is I think what you're saying is that every deal has its own cash flow profile, its own expectations, and those expectations under operations are going to derive that project's particular value. And that's what matters.
The particular value, and that's what is actually achieved in the transaction, the fair market value that was achieved in the transaction and the actual cost of the project. Now that's afterwards. That's a factual factor. The fair market value is determined by the cash flow. Construction cost is a fact. This is what it actually costs to produce. And when you look at the two, you have the step up. You can determine the percentage step up between the two, but that's what was actually achieved. Now remember, that date when the transaction happened is 1, 2, 3, 4 years after the entrepreneur said, yes, this is the project that I want to pursue. I have on my plate 5, 10 different projects. I'm evaluating what is the potential profitability? What's the potential value over the cost of all of these different projects? And I've selected this one to pursue, and I've actually brought it all the way to fruition. So it's probably one of the better projects. There are other possibilities that could have had less potential, but I chose to do this one. So up front, I had a expectation of what the profitability of this project may be. That's what we put into the cost approach. So it's a cost approach to value. So beforehand, before I built the project, I had the expectation that the value would be in excess of cost of X amount. By the time I was done, I have the power purchase agreement. I have the actual construction costs. Interest rates are where they are. Tax equity appetite is where it is. And that's what the fair market value is. That's the achieved profitability is the step up. In the cost approach, what we were talking about was the anticipated value that I was going to create by undertaking this multi-year, multi-million-dollar project. So it is important to distinguish between upfront entrepreneurial incentive is what we call it, and then the step up that's actually achieved at the end.
Now, not to throw a curveball at you, Marty, or Rick, please chime in if you like, but what happens, if anything, when you base the value of an asset on an income approach and you transact at that value, but then a few years later, it turns out that the cash flows produced by the asset were, let's say, wildly different than what the expectations were? Is there any sort of adjustment or look back or retroactive change that takes place? Or is it just a lesson learned to maybe take a different approach when prognosticating about expected cash flows?
It's making expectation. I mean, the cash flows at one point in time are the expectation as to what the earnings are going to be for the asset. So you're making a projection of, electricity prices, also the expenses that are associated with the operation of the facility, and you project that out over the expected useful life of the asset, and then convert those future values to present value by applying a present value factor as developed by the discount rate. And that's your, I'll say, best effort at the time you're preparing the appraisal to make an estimate of the value from the income approach. And of course, it's a projection. So the markets are dynamic. Things are going to be changing over time, and it's not going to be an absolute there that if you move forward, the markets can change and you could get a different value. But, for the purposes of the valuation of the project as of a point of time, you're considering the information that was available at that point in time in preparing your discounted cash flow analysis.
That's absolutely right. Even more fundamentally, the parties to the transaction are acting in arm's length. They're both predicting the future. All valuation and all transactions are about the future. What do we expect to happen? So when you buy a share of stock, or you buy a car or a house, it's all expectation of what benefit you're going to get in the future. Barring something in the transaction contract where there will be an adjustment based on future performance, contingent payouts happen, not in this market, I've never seen that, but it's somebody with an asset and somebody with money, and they negotiate and they make a deal. And it's done. There's no adjustment to the purchase price. So if it works out, as expected for one party or the other, great. Works out better than expected for one of the parties. Sorry, that's life. That you're trying to predict the future, you make a deal and you move forward with it. But Dorian, I don't know if you have, but I've never seen a transaction in this space where there's a purchase price adjustment of some sort based on performance in the first 2 or 3 years. We see that in other business transactions all the time, but I'm not aware of it in this market. It'd be very rare if it's ever happened.
And the question was about this market, but also valuation generally, and how this potential disconnect between expectations of cash flow and the established fair market value deviate. And I think I can say that in some cases, depending on the transaction structure, there can be something like a purchase price adjustment that can be handled otherwise.
But not in this space. I've never seen it in this space.
I've not seen it either.
That's all very helpful. And I think what you're describing is, again, not just specific to this asset class, but the expectation of cash flows underpins the connection between risk and profitability that drives any business activity that's conducted for profit.
It's all about the future. All valuation is about the future. Just remember, when we use cost approach when we look at actual costs in this market, when we look in this niche, when you're evaluating an equity investment and you're looking to price earnings based on past earnings, that's only as a benchmark, as a guide to what may happen in the future. In the price earnings, we use last year's earnings and today's price as an indication of value. Last year's earnings doesn't matter. I didn't own the stock then. I only own the stock in the future. All valuation is about the future, even if you use some historical measures as a way to measure the value today.
Sure. And you can only measure the data you have available. So maybe either for our next episode, I want to point out that in this particular asset class, there are, again, a number of value streams that are expected to issue from an asset once it is placed in service. So if we're in the business of producing electricity, it's the value of the production and sale of that electricity. It's value of tax attributes that are attached to the asset, whether that be tax-affected depreciation or tax credits of some sort. Maybe there are things like energy attribute certificates or RECs, as they're called in some instances, that might constitute a portion of that cash flow. So the point being that there's a number of items that are potentially flowing out of this asset that are the constituent pieces of the pro forma expectations of cash flow, which are, again, used to derive the value as determined through the income approach. So in our next episode, we're going to talk about some of those pieces and how to look at a transaction itself from a tax perspective. Once the value is established, what are the right mechanisms? What are the right steps? What are the right code sections that we should be applying in figuring out how this value manifests into the tax basis of an asset? So having said that, I want to thank Marty and Rick for joining me here today. And I hope that, audience, you can join us for the next episode. Thanks so much.